Okay, I think we are good to go. Thanks for coming today and joining us for um, a tactical guide to pre-seed fundraising. Just going to do some quick intros while we wait for Nash to join. My name is Peter Swan. I'm the CEO at Gust, where we build infrastructure for the early stage. That includes software and services for founders, investors, and the people who help them, with a focus on founders first. So this includes software like Gust Launch, which is everything you need to start, run, and fund a company from incorporation through Series A. So we take care of all of the nuts and bolts that you need to get in place to actually take money into your company, including incorporation in Delaware, issuing your founder shares, making sure you file an 83B, getting your bank account set up, and giving you all of the legal agreements you need to start to contract and take in money, as well as Gust Mission Control, which is a virtual startup acceleration program for ambitious pre-seed and seed stage founders. You can think of this as a fractional co-founder, CEO school, or an online startup accelerator supported by Gust tools. Um, Nash, intro
Hey,
yourself before we get started.
hey everyone, my name is Ryan Nash. I'm the CEO of Gust. I'm sure Pete's give a good intro about what we do and why we do it. You probably got an email from me inviting you to this event. So sorry I'm a little bit late. But Pete and I co-run Gust, have been for almost a decade. And we love startups. We love ambitious founders. We both have technical backgrounds. And we are going to tell you in a remarkably concise format everything you need to know to build a company that's fundable.
Awesome. And I know everybody is going to ask anyway, but we will be recording this and we will distribute it afterwards, along with some other follow-up resources. And feel free to ask questions. We'll have some time for Q&A. Nash will also grab questions in the chat and interrupt me with anything that is time sensitive,
The
or
time sensitive
applicable
thing
to the
is you have to
slides.
open up the chat to everyone. Otherwise, they can't ask questions in it.
Well, that's great. And we should really get it
That
set up so
default
that
set,
we don't have to do that every time.
I think this is an old template. It should be the three dots.
Okay, we should be good to go now.
There we go. Try out the
All
chat for me,
right.
everyone. Tell me where you're coming from.
So with that, I think we're ready to rock. And again, today we're here to talk about pre-seed funding, and we are going to try to walk you through all of the things that you should think about before you really dive into this process to avoid burning bridges or facing a bunch of no's that you don't understand. And the way we're going to start talking about this is just talking about why pre-seed fundraising is hard. And mostly that is because investor expectations change. Prior to pre-seed, you may have heard of something called a friends, and family round, or a friends and family and fools round, or a hustle round. But this is essentially you taking in money from your close personal network, people who are willing to bet on you and your idea. Maybe they are really embedded in your industry, so they really like what you're doing, or they've known you for a long time. And these people are basically willing to put money on you and bet on you earlier than anybody else. But the key there is that they are purely betting on you often before there is any business actually running, right? And this is a little bit different. When you start raising pre-seed or seed, you are starting to interact with actual semi-professional investors who know what they're doing, who do this a lot, who don't know you as well, and who are actually thinking about this as an economic activity. Now, lots of angels also invest in areas where they have personal experience that resonate with them from a philosophical point of view or a mission-driven point of view. But by and large, pre-seed and beyond, the people investing in your company are going to be doing it with an economic outlook in mind. So, an important thing for you to understand as you approach this round is that you need to align the expectations of your investors with what you're pitching and presenting from the pre-seed standpoint. And really, that means understanding angel economics. The biggest thing to understand there is that 90% of the startups that angels invest into fail to actually return the types of returns that make angel investing a viable financial opportunity, right? So, angel investors, by and large, if they have a capital I in that investor, are looking for a return that matches or often beats the stock market, right? So, to get these type of returns with a high failure rate, they're looking for relatively big outcomes. And to get an idea for how big, we can look at kind of the expected return on investment for early stage investors. At the seed stage and prior, angel investors are typically looking for around a 30x return on their capital. If you start talking to early stage VCs who actually invest at pre-seed, often they are looking for a 100x return on capital, right? So as soon as you take investment, you are putting a very large return expectation and revenue trajectory on your company. And if we look at that a little bit more in depth, we'll take an example here of you raising $1 million at roughly a $7 million valuation. If we look at that from a 30x perspective, we get an $8 million post-money valuation. 30x that, you're putting an expectation for an exit of above $240 million. And if we look at some average exit multiples, and again, these will change based on industry, but we're taking a median for a technology-focused business of roughly 6x your revenue. That means that as you're approaching pre-seed and seed stage, if you are taking $1 million from investors, you have to convince them that your business can grow to generate at least $40 million in top line revenue to put you in the neighborhood of the exit expectations of those investors. So this is difficult because this means that you have to build a very big business. But it is nice because you have a very clear target that you can construct your raise and your pitch around. And the way that we like to think about that is that your job is telling a compelling hard science fiction story about how you and the people around you are going to build a business that is generating at least $40 million of revenue somewhere in the next 3 to 5 years, and how you're going to credibly approach that 3 to 5 year goal with the money you're raising now. So, what are the concrete business objectives and outcomes you're going to achieve with the money you're raising? And then we're going to break that down. So, if we look at a compelling hard science fiction story, right? When you read a hard science fiction novel, you are under no impression that what you're reading is truth, right? Everybody agrees that this is fiction, but it's a fiction that is well researched and believable and an extrapolation or an extension of things that can be believed and are credible. So, from an investor perspective, this means you have to articulate a big and growing market. There has to be a team or a crew capable of actually approaching and entering into this big and growing market. You probably need somebody very trustworthy from a leadership perspective to guide this. You need a compelling and believable plan for how you're going to achieve it. All of this has to have some roots in reality and things that are believable today. And the way that you can really convince somebody that your future based on current reality is believable is by generating some actual traction. And traction is one of the things that we see founders get confused about the most. So we're going to dive into that a little bit now. And we're going to start with what traction is not. All of these things are validation, right? Funds raised, a great product, a good idea, mentions in the press, intellectual property like patents, people on the team who have done this kind of thing before or have a specific special sauce or knowledge in the industry, your ability to market, the startup programs you went through, the AWS credits you've gotten, awards you've won, accelerators you've gone through. All of these things are good and increase your credibility in the eyes of investors, but they are not traction. Because our definition of traction is something outside the company's control that is demonstrating that what you're doing in the business you're building has actual value to the market. And what that actually looks like is paying customers if you can get them. Even if you don't have a technological product ready and it's just duct tape and glue, can you convince somebody to pay for it? Can you get a letter of intent? Can you get somebody to sign something that says, if you build X, Y, and Z, they will pay A for it in real dollars? Can you get it signed? Can you show it to other people? Can you sell contracts prior to having something ready? Do you have users or interest that is growing? And are any of these things done in a way that is repeatable and accelerating? These are the core tenets of traction, even at the earliest stages. These are things that start to build belief that the market is willing to transact with the idea behind your business. And just in terms of level of traction that we're looking at here, in terms of big revenue dollars and things like that, in your hustle round, you're raising roughly 500K, and this is before you really have anything, right? So this friends and family round can get you all the way up to that. In pre-seed, maybe you're raising 500K to 2 million, where you're starting to demonstrate actual traction. And then seed and series A and beyond are going to be much larger numbers, but based on much bigger traction levers and demonstration. Now, oftentimes in the earliest stages, you may not have a ton of traction, right? Especially in pre-seed, you're just coming out of friends and family. So absent that, or even if there is a nugget of traction there, one really important thing to communicate to investors as you approach them in a funding round is a compelling plan on how you're going to either get initial traction or continue to accelerate and increase the repeatability of the traction you already have. And that brings us to one of the biggest mistakes we see founders make in pitch decks and in talking about their round is saying something like, we are raising $1 million to finish our MVP and bring our team on full time. Remember that when you are pitching and when you're asking for investment, the perspective you need to take is the perspective of your audience. It's not what you think you need as a company. It is what you need to achieve a business outcome that proves to the people who are putting money in that there is potentially a return there. So this just isn't good enough. Your ask has to be tied to concrete use of funds and valuable business goals. So if we look at this and see and think about how we can make it better, right? We're not raising $1 million to finish our MVP. We're not raising $1 million to bring on our team full time. Maybe we're raising 500K to reach our first 10 customers and find a repeatable strategy for our next 100, right? Just flipping how you're talking about this from what the company needs to what the company needs to actually achieve something really amazing that points you in the direction of a roughly $40 million company. And this needs to tie all the way down to your use of funds, right? We often see, okay, we need $1 million to finish our MVP, and then a pie chart that says, okay, this is how many developers we're going to pay, and there's going to be some marketing spend. But you really want to think about communicating to investors at a high level how you're going to use this money to achieve the thing that you just talked about achieving. And if you can do that, it starts to build a narrative all the way down to the things you're going to credibly do with the money that you are asking for. So, okay, you have a use of funds. We're going to get this many customers and achieve a repeatable path to this many. And we're going to do that by using the funds in these ways, right? Shoring up our MVP, which is going to relate to product spend and contractor spend, leveraging founder-led sales, which great, we don't have to spend a lot of money on, and testing 4 key marketing strategies to extend those founder sales beyond and make them repeatable in a way that can address the market. And if you look, the color coding here is tying back these statements directly to our pie chart and making it easy for investors to draw a line all the way down from kind of our big financial outcome through to how we're going to use the money from a bottoms up approach after we raise it. The next component of a compelling hard sci-fi is that it is actually rooted in reality. And this is where we see some other common mistakes in financial modeling. Once you start to break down that kind of nice graph of revenue growth and investors start to ask, okay, how are you actually going to achieve it? We often see that growth comes from nowhere. There's just a percentage growth in the financial model that says, okay, we're going to grow 10% month over month. Or it comes from everywhere. Like, oh, we're going to use this money and we are going to have partnerships and we're going to do paid marketing and we're going to do social and we're going to do organic. And if you're focused everywhere at the pre-seed or seed stage, you're really focused nowhere. We also see mistakes around growth, not respecting market constraints. If you talk about the number of people you're going to reach in your total addressable market, your serviceable addressable market and your serviceable attainable market, you want to make sure that your financial projections don't extend beyond the bounds that you've laid out there, right? So everything needs to connect as soon as you have numbers of customers, revenue, make the math work throughout the communication of what you're asking for. We also see unrealistic marketing spend, margins that are too good, not accounting for headcount, um, thinking that sales reps are going to be far more scalable, not taking in ramp up time for those sales reps, and not taking in sales cycle time for larger accounts. So you really want to make sure that as you're putting together your financial model, you're taking the time to think about like, okay, these are the goals that I want to achieve from a top-down level, but can I credibly explain how I'm going to try to achieve them within the bounds of reality? How much are these things going to cost? Who is going to have to do them? What is churn realistically going to look like? How long is it going to take each person to sell each client? Does revenue start now or does revenue start 3 months from now? It's a good exercise to build those things bottoms up. So again, you can communicate a credible story that's rooted in actual reality, and convince yourself that you'll be able to use these funds in a way you are very confident in convincing investors about. And the easiest way to deal with a lot of these things is to build a financial model. We partner with a company called Forecaster that builds great software that we now use to manage this for ourselves because it can be a pain in the butt. But the key with all of this stuff is that it allows you to quickly build and iterate around a bottoms up approach where you can really explain the growth through activities that you are going to do and pay for with the money that you're raising. Now, if you can tell a compelling hard science fiction story, that is awesome. That is the hard part. You've got the traction, you've got the credible plan, you've got a great team. The next thing you need to think about before you approach investors is avoiding all of the easy no's around basic diligence and structure. Here is a brief pre-investment checklist to make sure that you think about the things that you need to think about before you actually go and approach investors. In addition to being incorporated, you do need to make sure that your company is fully formed, is in good standing with the state, and has all of the structures of corporate governance set up. Typically, and we'll talk about this a little bit more in upcoming slides, as a startup seeking equity investment, you will likely want to be organized as a Delaware corporation, and your Delaware corporation doesn't establish liability protection for the founders and the board members until you have founders and board members and shareholders. It can't actually take on investment until the board signs off on it. And if you haven't established a board, then the board isn't there to sign off on all of these things. So you want to make sure you have the full structure in place to actually have a fully formed company with the corporate veil established, limit liability for everybody involved, and have the company set up to sign off on all the things it needs to sign off on to have a nice corporate governance chain around your fundraising. That included, in addition to establishing shareholders and the corporate governance, you want to actually have all your equity granted and properly vested with the people who are currently involved in the team to make sure that incentives stay aligned, they aren't accidentally missing out on financial upside, and that equity is in place before you take in money and bump the valuation. You also really want to make sure that the valuable things about the company are actually owned by and under the umbrella of the company. So that means any work that has been generated by founders, co-founders, contractors, early contributors, anybody else needs to be tied to the company. Often for founders, this is done when founders are granted their shares in the form of an intellectual property assignment agreement. For contractors and advisors, very often their contribution of IP is covered in the agreement that outlines their relationship with the company. As a contractor or advisor, very important to make sure that that stuff is credibly tied to the company so that when an investor comes and looks and says like, oh, okay, it's this software or it's this patent or it's this work that makes the company valuable and that gives me confidence that they're going to hit that trajectory. Oh, but the company doesn't own it. This guy owns it. And he hasn't been granted equity yet. So he doesn't even have ownership in the company. And now he's got a nice big lever to negotiate on his own behalf and not contribute to the whole.
I
And the
think
last piece. Oh,
Oh, sorry. I just want to interrupt because something we were just in a webinar with Forecaster and people keep asking about data rooms and diligence. And I think founders ask about it in the wrong way. They're like, how do I do good at due diligence? Or how do I do a good data room? It's like before anybody asks to see it. Like run a good company with good corporate governance, and usually diligence is actually pretty quick if you have all your stuff in order. If you're from your 90-second pitch down to like digging into your financial model and looking at your corporate history, is if everything supports everything else, diligence is a box checking exercise.
yeah.
But things get really gnarly and nothing kills a deal like time. Where if it's like you get all that enthusiasm and expectation, even your financial model is great, but then the investor starts looking through the docs and it's like this thing's a mess. Like it's such a just momentum killer.
Yeah, I think that's a good way to think about it, right? Your data room should just be a collection of things that you've already done, right? And the artifacts that those things have produced. Oftentimes what happens is when startups go and have the need to put together a data room, they realize they haven't done a bunch of stuff, right? So constructing the data room is actually an exercise in going back and fixing a whole bunch of things, or putting some basic things in place that just weren't done or were ignored up until that point.
And lastly, to just kind of put a finger on it, we, as an anecdotal thing, we recently did a deal where the conversion to a Delaware C Corp was contingent on some of the investment, but it spurred a bunch of conversations that actually put the company in a better position. And most investor groups and things like that, like Gust is kind of singular in the space and how we support founders and, we understand where they're coming from. But most investors who are just professional would often not even wait for those things to kind of happen. If they get to like enough red flags and sticky tape and like, this founder has to go do so much and they're going to be cleaning up rather than building the business, I'm out. Um, but the process is not just to, get your like A plus citizen of the month kind of award, but it's also good for you. If you have to go and say, hey, co-founders, we need to sign these stock grants. Yeah, we're great friends. We're really good. It's 70-30. We totally agreed to it, but we have to execute these and sign these. Humans' brains go into a very different position when they're committing to something like that. And that is often good for the business, even though it feels like it might be uncomfortable up front to really like have those conversations and like put them to paper. Sometimes it's actually going to put you in a stronger, well, most of the time, I think it would put you in a stronger position should you start to build up momentum.
Yeah, absolutely. And same principle applies, right? if you if it's hard to get the document signed and get the data room together, it means you kind of skip some steps, right? So if your co-founders aren't really aligned on what ownership is going to be, or aren't really aligned about how long this company might take, that's what makes the box check of stock grant signed, IP contributed difficult, is because the pre-work hasn't been done. And I mentioned this briefly before, but if you're a startup looking for equity funding, by and large, investors, especially professional ones, are going to expect that you are organized as a Delaware corporation. And that's because still to this day in the US, it is an ideal structure to organize a large number of people in pursuing a big, risky bet. A key thing to understand when you are taking equity funding is that you are signing on to a shared enterprise that is going to be collaborated on between the co-founding team, its employees, and its investors. All right, you are taking a step back and thinking about this as an entity that exists beyond any of the individuals that are contributing to it. And the real reason that a Delaware corporation in particular is important to investors is that Delaware, above any other state, even those that have similar corporate codes to Delaware or states that have put in some other niceties designed to get more companies to form there, is that Delaware has a huge body of case law that gives investors confidence about how the Delaware corporate code will actually be applied in practice. So the way things typically work in the United States is that the law is written, but it is open to interpretation by the courts. So every suit that is brought, every challenge that is brought, goes through the court system and establishes establishes precedent that gives everybody confidence that okay, this is how the court will apply this law in practice. Delaware has built up a very high functioning and efficient chancery court that has built up a huge body of this case law that just adds additional confidence for everybody involved above what is typically available based on the histories of these other jurisdictions.
And this is a good spot to just grab a question that came up in the Q&A from Yazan Kail. Does Gus only focus on US based startups or USA startups?
It is our broad focus, but really our broad focus is companies that are incorporated in the United States or companies that can attract US investment. And that does not necessarily mean that the headquarters of the company is in the United States. We just recently got back from the Angel Capital Association Summit, where we heard some really interesting stories about economic development efforts in other countries where the folks starting businesses there and the folks helping them realized that the local laws just did not abide equity investing into startups. So what they ended up doing was organizing all of those companies as Delaware corporations with a foreign presence in order to get investor money into those. That included investor money from people who had immigrated out of the country but still wanted to support investment back into it, as well as local investors who wanted to invest in startups but were unable to based on local laws. Right. So there are a whole bunch of reasons that a company or founders outside of the United States would still choose to create a US entity. And there are a growing number of investors willing to invest in companies outside of the US, sometimes contingent on them being organized or having a US based entity, but even sometimes not these days. And real quick aside on this in particular, all of this ducks in a row, avoiding easy no's. It's complicated and it's weird, and founders often trip up because they don't understand what the investor perspective is on all these things. So we recently introduced a free tool that you can use to just answer some questions about your organization leading up to a pre-seed or seed stage funding round and get some feedback on where you stand, where the risks are, what the things are you might want to fix, or where the things are where you want to make sure that you have a really compelling story. You can find that at this link through this QR code or at gus.com/corporate_diligence. Lastly, going into a pre-seed and seed stage round, you do not need to become an expert in this, but you should roughly understand what the structure of these investments looks like so you can properly advocate for yourself and so you can avoid putting your foot in your mouth. Investors, especially professional ones, do not buy common stock in a company. And often in the earliest stages, pre-seed and seed stage in particular, they don't buy equity at all. What they invest on is something called a convertible instrument, which is money in now in exchange for equity later. And the reason that this is done is because it is generally cheaper to close. There are less things to negotiate between the founder and investor. It can encode some investor protections and some upside for the investors. And generally, what will happen is at a later date, when the company does raise money by actually selling shares, everybody who holds an investment in a convertible instrument will convert into equity at that time. And that's called a qualified financing. Usually, that will happen in conjunction with a round that has the word series in front of it. Most commonly, Series A, but you'll sometimes also see Series Seed, which generally means that a new class of stock is being created for that funding round in order to sell that stock to investors. So common stock for founders, employees, early contributors, et cetera. Convertible preferred shares in a new series for each round of investment once you start selling shares to investors. And you'll see a couple common convertible instruments out there. Probably the most predominant right now is the Y Combinator SAFE, stands for Simple Agreement for Future Equity. This is the instrument used, I think, predominantly in pre-seed and seed stage fundings, especially in kind of coastal VC ecosystems, West Coast, et cetera. You'll also see convertible notes, which are the preference of the East Coast Moneyball folks. From your perspective as a founder, there are some slight differences, but they operate in very much the same way. A convertible note is a debt instrument, so it sits on your books as a loan. It has interest until it converts, whereas a SAFE is not. So a SAFE is typically seen as more founder friendly because there are less investor protections, which is why some investors don't like them. But realistically, if you are asking investors for money, your lead investor, the person who's going to put the most in, is going to help you set the terms and probably has a preference in terms of the instrument. And everybody else, even if they say they have a preference or they won't invest for X, Y, and Z, if you're doing well enough and you have a lead, they'll come in on whatever instrument is offered. And there are a couple ways that investors kind of encode their upside in these early convertible rounds. And the most predominant is a valuation cap. And a valuation cap just means that when the money converts, even if the new investors have settled on a valuation of $10 million, if the valuation cap of your convertible instrument, a safe or convertible note, is 5, then the investor money on that convertible instrument converts as if the valuation of the company was 5 directly prior to the financing. And another trip up we often see at the pre-seed and seed stage is that companies will belabor their valuation cap quite a bit and try to tie it to their financial model using some sort of discounted cash flow, when in reality, there's very little credible evidence of traction and revenue. So those types of methods don't really work. So generally, the best way to think about this is that typically at any financing round in an equity financing track, founders are going to sell anywhere between 10 and 20% of their company. So the easiest way to think about this is to determine how much money you need by doing that bottoms up analysis and then figure out, okay, if I sell 15% of my company for this amount of money, what is the implied valuation of that? And as long as that implied valuation is somewhere around industry norms and market standards at the time, then you should be in pretty good shape. And that is the easiest way to think about it. It's also good to understand the difference between pre-money and post-money. The original version of the Y Combinator safe had a pre-money valuation cap, which really just meant that any other investors that came in on convertible instruments after investor A would dilute investor A's ownership percentage and dilute your founder percentage. With a post-money valuation cap, investor A is protected and they are not diluted by future convertible financing. So that is not necessarily a good or bad thing from your perspective. It does make the math easier. You understand exactly how much each investor is getting in ownership prior to the conversion. You just need to be aware that each of those investors stacks up and that their total ownership is cumulative. So once you understand that, you can avoid surprise or excess dilution when those things convert. And
We
just
got a
remember,
relevant. Oh, go ahead.
yep,
Sorry.
have
We have a
it.
relevant question in the chat. Any downsides to having a safe with no valuation cap?
Downsides for your investors, yes. Downsides for you, maybe, because if your investors are pissed, you probably have some trouble down the line. But typically, if you're going to see a safe without a valuation cap, there are a couple common situations. The first is that it's really early. So if you're still in that friends, family, and fools, and you are working with lowercase I investors, and there's not enough information at all between the investors, the founder, and the traction of the company to set a valuation cap that isn't going to potentially get you in trouble later by being too high or too low, then you can use a discount to give those people some upside and avoid setting a valuation cap. Very often, what will happen and what we've encoded into the Gust docs is that if you take in money from friends and family without a valuation cap, and then you later raise with a valuation cap, those early investors will automatically inherit those new terms. So they'll have the benefit of the valuation cap that is negotiated by later, more sophisticated investors without having to put the valuation cap on now. That is because our philosophy is generally that founders should be upfront with investors, and that this is a collaborative effort where nobody is consciously trying to kneecap the other side or screw them. Certainly, it's a negotiation between investors and founders, so a good negotiation leaves both parties slightly unhappy. But as much as possible, we want to balance the investor outlook with founder safety.
Yeah.
The other common time you may see this is for kind of a bridge round, a little bit of money that is coming in to extend runway when the next round is on the horizon. And sometimes you will see that money come in either with a discount only or through what's called a most favored nation safe, which is, okay, cool, this money's going to come in now, and it's just going to inherit the terms of the next money that comes in. So very often those are super simple. There's nothing really to negotiate. It's just quick money in that is immediately going to be converted or inherit the terms of the next money that is intended to come in the next 3 to 6 months.
And this is great. This answers another question from Mark Colangelo. Uh, there is no rough answer to whether it's best to have a cap, discount, and or MFN. It fits your situation. Those are all the tools to basically map the fundraising to where you're at. If you're taking money from unsophisticated investors and it's super early, an NFN is great with a discount just because you can figure it out later. And if you're on good terms with them, great. Nobody has to commit to anything, so nobody gets upset in the future once you have more information to work with. If you're a little bit further along, you can evaluate it with, the investors that you're talking with, what makes the most sense. The world does seem to be moving into a valuation cap world where once you're past the MFN kind of early situation, that's what people focus a lot on. But all the tools are there, and you can use them to do what's best for you and your investors.
Yeah, and a valuation cap is a stronger investor protection, right? It doesn't key off the later valuation and discount from it. It says this is the maximum valuation that we will pay, right? So as long as things are going really well, the valuation cap is a better investor protection, and that is why it has become the predominant one used by professional investors. And a couple other points which lead to some of the confusion around what a valuation cap or valuation is at the early stages. It's not a point in time valuation of your company, right? So it doesn't say this is what your company is worth now. It is a future facing projected valuation by investors, betting that the company can be worth significantly more than this valuation by the time it hits its next round or inflection point. It is not a valuation of your common stock. It is also not tied to and explicitly not a 409A valuation, which is a type of valuation of your common stock done when you go to issue options to employees of your company.
All right, before we jump on to kind of tactics for too early, a couple more questions on other funding sources. What about alternative debt-based financing for early companies?
It exists, but there are a few different flavors, right? There are some really cool things happening with revenue-based financing. There are cool things that you can do with inventory financing or invoice factoring and all of these other things. But typically, all of those require some significant traction in the company, right? So hundreds of thousands of dollars in annual revenue, or some inventory on hand that actually cost real dollars, or some invoices or contracts that actually have money tied to them. Um, if you talk about early stage debt financing outside of that, largely that debt financing is going to be guaranteed by you personally. So it can be a more dangerous for your personal finances method of financing. If you go out and get an SBA loan, you're gonna personally guarantee it, and most of the other financing options early stage will require a personal guarantee from you, unless the business has some traction that you can basically leverage to get money in. And that is why equity financing exists. It is a form of risk financing that can abide the level of risk of an early stage company, but that's why it involves equity and not just like a payback percentage, right? They are trading risk now for the potential of much larger upside than a typical interest rate.
Well, I queued up a bunch of questions for the Q&A because we have plenty of time for it, but
Cool.
let's finish up the presentation and we'll get to that.
All right, so we touched on this a little bit, and this is kind of why you want to avoid early easy no's, right? Because it's still really hard to raise. Typically, angels will invest in 1 in 40 of the deals that they see. VCs will be even more selective. So it's really hard. No can mean a lot of things. Very often, what no means from professional investors is I do not see a credible hard science fiction here where I can put in dollars X and see, 3X X come out the other end, right? So you are going to hear too early. It's still going to be really difficult. You're going to have to pitch a lot of people. So as you are actually going through that process, there are a few things that you can think about. The first is very often with the startups we've worked with, we see them come out with a very large raise that isn't yet tied to a credible business outcome. And as they get no's from the market and as they litigate this further, a question that we work through with them is, okay, is there something really cool from a business perspective that you can pursue with less money, right? Is there an inflection point earlier than the one you're talking about that is valuable to hit, that increases the real tangible value of the company that costs less money? Right. So can you do a smaller angel round rather than a 1.5 million to $2 million VC led round? What are your options for different types of equity capital? And then the other is to just make sure that the people who might fund you and the people who might join your team when things are a little bit more reified and real, make sure you have a way to keep them in orbit. One of the best ways to cultivate a future investment relationship is to actually form a relationship with that person where they understand who you are, what you're doing, how you're dealing with problems, the types of progress you're making. And a great way to do that is through company updates. You will often see these referred to as investor updates. We like to think of them as things that start prior to getting investors. Structuring these so it reminds people who you are, talks about what you're doing, really explains your hero's journey, and shows how you are tackling a really big problem and that you are, in fact, making progress and being candid about where you need help or where things aren't working do a tremendous amount both to increase kind of the third degree relationship you have with somebody, show that you are building towards a credible business, and give you a way to mobilize that network of people prior to asking them for money, right? So having a clear ask on a monthly basis that is changing gives everybody in your network the opportunity to understand whether or not they can plug in and help you right now. And for those of the that want to dive deeper, it gives them the opportunity to kind of self-select into helping your company, whether that is through tangible work product, advice, or money.
I think this is the answer to the question we get all the time. It's like the proactive answer of like, where do I find venture capitalists that invest in blank? How do I find investors for my business? How do I find a co-founder? All these questions, like you're running into those kind of people every day if you're actively trying to build your business. If you're not at the stage where you can credibly raise a round, the best thing you can do is start to build up that network. And the easiest ask is if you find somebody who's interested in you and you're kind of interested in them, even if you have no idea what the relationship would be, investor, co-founder, advisor, first customer, whatever. If you like it and your simple ask is like, hey, can I add you to a list of updates that I send every month about how I'm trying to do this ambitious thing I care so much about? Chances are 80 to 90% of them will say, yeah, that's kind of cool. I want to hear about it. And then as you build momentum, you're going to find yourself with in a way better position than like, oh, I'm ready to go raise funds now. Where do I go and find hundreds of investors to talk to? It's like, hey, you might have your own list and they're already, you know, pre-greased for a weird term to be receptive to your communications and things like that. So the earlier you can start with this, the better. Most people who do this really well find it pays dividends in ways they didn't even expect.
Yep, and this is how we have found some of our best partners, including Forecaster. When we first met them, they didn't have a product yet. We were like, what you're doing is really cool, but it's not, it's too early for us. And they're like, okay, can we put you on our company updates? And they did. And eventually they became one of our primary partners. And then our angel group also invested in their seed extension round. So it really increases kind of the surface area of serendipity, which is just like a necessary thing to increase your network, to increase the amount of kind of luck hits you're going to get as a startup. And if you are preparing for any of this, as I said before, we can help. We talked about the corporate diligence review tool a little bit earlier that can help you kind of gut check where you are on that easy nose checklist. We also build Gust Launch, as I mentioned at the beginning. This is a fuller breakdown of what that offers, but it is pretty much a startup in a box that gives you all of the things that you don't want to think about and learn in a click-through educational experience to help you along the way. And mission control, the way we deliver this acceleration experience is basically weekly office hours and workshops. Workshops dive into critical problems that individual founders are facing. We bring in experts to help them navigate. You get a network of fellow founders and people who have done this before, people who are currently doing it. You'll get chances to sharpen your pitch and practice with investors before you actually have to give your pitch to somebody that you're asking money from. Can help you wrangle back office challenges. And because it makes you so easy to support, you get 40% off all Gus software, including Gus Launch. And that's where we'll leave it with a perfect 15 minutes for Q&A.
Amazing. And Erica just asked a question in the chat. Do we have examples of what company updates look like? Heck yeah, we have it in Mission Control, what Pete is talking about right now. We actually have a whole module that walks you through with videos and what to go into it and some examples. I'm trying to pull them out right now, but I'm not going to be able to get to it offline. But check us out. We actually do kind of company update reviews throughout the program. We do workshops around it, and it's super worth it. We've got tons of questions. I got a list. Let's get going. All right. All the way back, Steve asks, and we're going back to the pre-seed and pre-seed traction terminology area. Are those names pre-seed, seed based on the size of the raise or the amount of traction achieved?
Well, those things are really tied together, right? So often they will be very, very similar, right? So the amount of traction will be critically tied to how much business value is there because people are willing to bet more money when more of that money will be for growing something that's already working rather than proving there is something to grow. There are outliers though. So whatever's currently hot in the VC market, whether that is blockchain or AI, sometimes the size of those raises, because it is hot and because market timing is such a big thing, the size of those raises will outpace the median for other sectors quite a bit at the pre-seed or seed stage. So things can kind of get out of whack there. And then there are just generally more capital intensive businesses. So things like medical devices or other things that have to go through a heavy regulatory process on the path to market, where just the size of the raise is different.
Awesome. All right. Next up, we've got Rob asks, what are considered real traction by investors? And then what are things that the founder often thinks are traction, but the investors think are not? We covered a little bit of this.
Yeah, let's see if we can go back. Okay. So a lot of times we see traction presented as I got into the AWS for Startups program. They gave me 50K credits. People will talk about that as traction and previous investment, not traction. Anybody can go and apply to AWS and get 5K in credits. An accelerator program, right? You've gone through a program, you put a badge on your pitch deck that can help validate that you have done something and that you were serious and that you have done something hard, but it's something you did, right? Nothing to do with the market pulling from you. So not traction. Press release, you can pay for a press release, right? If you can do it, if it can come from you, if you can build it, if you can make it happen, then it is not the market pulling you, right? So think very hard about that. There are some things that blur the line, right? If you get into YC, that means you went through a very rigorous selection process, and you are essentially guaranteed funding through demo day to some extent. So you are de-risked in a way that kind of shows something more than just validation, but still not traction. Doesn't mean your business is working. It means somebody thinks your business might work. So that is the clearest distinction we can make, and the most intuitive way we've found to talk about it is that if you can't manufacture it yourself, right? If the market is literally pulling things out of you, throwing money at you, really asking for things in the same way that people describe product market fit, then you have some traction, right? If somebody's willing to buy it, it lends credibility to the problem and that you have a solution that is recognized by the people you're trying to sell to.
I think the easiest rule of thumb for this is if a thing that you do gets you excited and you feel like this business is actually growing, chances are it's traction. But if at any point in your heart you're like, oh, if I put this on my pitch deck, I have to represent this in a certain light in order to make it seem like I'm validated, that's probably not traction. If you applied to a local accelerator program that accepted everybody that applied to it, that badge, that you're going to put on your pitch deck, that's not traction. And if anybody digs deep, nobody's going to look at it in your 5 minute pitch, but if it later you start to lean into it and it comes up in diligence, it's going to give you a ding. I think the last thing I see all the time is activity from outside your control that is not tied to the business model that you're actually building. So it's like I have a huge social media following, and as soon as I just get, 500K to build this app, I'm just going to flood it through my network and they're all going to download it and we're going to be rich. And it's like, why do you have a social media following? Could be completely unrelated to the business, right? Maybe you're just a funny person online. Maybe you had a viral moment. Maybe you had it from a completely different job that has nothing to do with the business you're trying to build. Or, you're building up a ton of free users. Oh my God, we have free users all over the place. They keep growing. That was kind of cool 15 years ago. If your business model is an advertisement-based business model and you're growing literally into the millions, like free users is traction if there's a monetization funnel on the other side of it. It could be one that you haven't turned on yet, but if it's validated, if selling data is your business model, that's traction. But that's only very few startups. I think the post Google era, the post Facebook era, there's so many startups who are based on like, give it away for free, we'll get huge numbers, and then we'll raise VC money. That's just not there anymore.
And just to double down on this, Michelle asked in the chat if traction could be letters of intent to white label your product if it's a large, well-known entity. Yes.
Yep.
Anything that looks like a contract that says, I am going to pay you this amount of money to use the product that you are developing is can count towards traction. Obviously, if you can get them to pay first, that is even better, but sometimes that is not possible in an enterprise setting. But if you can get a large, well-known entity to say, yes, I will pay you, and the person in charge of the buying decision is willing to sign a letter that expresses that directly, then yes, that is a very good indicator of early traction.
Awesome. Next up, we got any advice for positioning a portion of the use of funds being paying out the founders in the early executive team? This is how you're
Um,
going to spend it.
yes, be careful. Investors do not want founders to starve. They want you to be able to support yourselves. So come at it from that point, right? Come at it from, hey, we need some money to survive and pay for XYZ. We have carefully calculated it, right? Founders of pre-seed and seed stage companies do not get market salaries or above market salaries. They often take a hit on their salary in order to compensate early team members who have much less ownership in the business and incentivize them to come and work on something early and risky. Founders take the salary hit early on because they have a huge chunk of ownership in the company. And they, just like their investors, are betting that the near term revenue, the near term salary that they can get somewhere else is less valuable than the long term value they're going to be able to build very quickly in the business. Right. So that is the bet you're taking, and that is the bet your investors are expecting you to take. So, like we said before, if you come into your raise and say, "Hey, we're raising $1 million," so that each of the co-founding members who each own, 50% of this business can get paid 400K a year, you're gonna have a really tough time selling that to investors.
Awesome. And we're going to get into do do do. Let's go to David's other question, then we'll jump into the time-ordered stuff. How do you get investors to accept that there are always assumptions in the model? This is back to the hard science fiction, and they can't wait on the sidelines until every assumption is rock solid. I think you covered this abstractly, but I think we need to dig in a little bit more about what is the tipping point for investors on your financial model and the actuals.
Well, it's going to depend investor to investor. But if you are working with somebody who has equity invested before at the early stage, their expectation is often that you have a credible plan that is rooted in reality in some respects, right? So they know that it can't be true because it hasn't happened yet. But if you can show that you have done it once or twice and you think it could be scalable, then that's better. If you have an equation that says, hey, this month over month growth that we plan to achieve is based on this much marketing spend at this cost of acquisition, and we are basing this on some market comparables, that is much, much better than, oh, startups grow 10% month over month, so we're going to grow 10% month over month. All right. So if you lay out a credible plan that is as close to an extension of recognizable reality as possible, then typically that will be enough for people who actually bet on early stage startups. But especially in emerging ecosystems, you may get people who are used to a much more rigorous business model or financial plan early on. Um, and it may just indicate that they aren't the right investor for your company at that time.
All right. All right. Steve asks if we're pitching to investors and we're on the ask slide, which is usually how much you're raising. Do we specify the cap and discount or leave it out for later negotiations?
I think it depends, right? You certainly can if you have a good idea of what it can and should be. If you need some help on that guidance, Carta publishes great data, and Gust has a pre-money valuation tool that you can use to ballpark this. What
We'll
you
grab
want
a
to
link.
make sure of, though, is that whatever terms you are putting there are recognizable in terms of current market norms. Right. If you put terms there that indicate you're going to sell 2% of your company at this round, that is going to do you a disservice because investors are going to be like, well, that's dumb and they don't know what they're talking about. If you have amazing traction and everything else is good, they might not care. But in other cases, anything that you do that indicates you don't know what you're doing, um, knocks a block off the tower you're trying to build.
Yeah, I'd say the most compelling ask is we need this much money to accomplish this outcome. That's where you start as your round starts to metastasize into something that you've had conversations that shape it and you get more and more
Yeah.
details, you can start to do it. If you get a lead investor who's like, I'm investing 100K and we've agreed on this valuation, that actually changes your newer fundraising conversations into things with more momentum behind you. It's one thing if you say, I made up this number and I'm asking for funds on it. It's an open point of negotiation and it might be you telegraphing too much. But if you've already locked somebody because they agree with how much you're raising and what you're going to spend it on, and you guys agreed to it, awesome. Now you give investors a faster path to investment because they don't have to have those conversations with you. The deal is clear. And so that's really kind of how you want to warm the channel. And this is also why, if you're running a serious fundraising process, you want to do it as a blitz. You want to do it in a month and a half when we're talking about investor meetings. You're going to warm up a lot of things with months leading to it, but when you kind of hit the trail, you want to get to the point where you can build that momentum and your slides will change throughout. All right, we got 1 minute left. I know we're going to have way too many questions that we won't get to answer. This is why we do what we do and the services that we have. We help with this on a weekly basis. We literally have office hours every Wednesday where it's just open Q&A. And we always go over by about 4 or 5 minutes, and that's my fault. But we help as many founders as we can. Any one last question that really appeals to you, Pete?
I don't have them up on my screen, so I can't tell you.
Da, 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 da. All right, we'll
Yes,
just
slides
do.
will be available after the call.
Yeah. Here's a fun one because it's a little murky. And Yazan, you've asked some good questions in the chat. What if I raise money on my own valuation and then it turned out to be less valuable than I expected? Would investors ask for more stock?
Sort of, but really what that is called is a down round, right? So if you peg the valuation too high and you don't exceed it by the next time that you are raising money, right? And by exceed it, I mean you don't have the ability to convince somebody that you're worth more and you really need money to keep the business going, then you may have to accept an investor valuation that is under the valuation you previously raised at, which is called the down round. Generally, that means that everybody who owns equity or would own equity based on the current cap table and investor stack gets squished down. So instead of owning X percent, they will now own Y percent, where Y may be significantly less because the whole idea of this stuff is up and to the right. So that is the danger of setting a valuation too high, is that you, the team that owns common stock, and the investors prior to the down round all have what they thought their ownership was squished by future investors who have leverage.
Awesome. All right, let's wrap right on time. Thank you, everybody. Sorry I was a little bit late. Please check out the stuff we offer. We have a great time helping founders and supporting them. And all of our tools, free and paid, are just designed to hopefully translate this, provide this at the scale we can to help more founders, regardless of, whether they're in Silicon Valley or New York or all the places in between. Look out for more from us soon. Have a great rest of your week, everybody. And thank you, Pete.
Thanks all. Appreciate you being here.